What's up, expats, and welcome to another edition of Expat Tax Questions, where today we're going to talk about some of the sneaky reporting requirements when it comes to FBARs, or foreign bank account reporting. So the scenario we have here is a U.S. citizen individual living in Costa Rica, and he has two Costa Rican bank accounts. Let's call them bank account A and bank account B. So bank account A at the end of the year had 9,000 US dollars in it. And I'm going to use US dollars just for simplicity's sake. Bank account B had zero in it, nothing, at the end of the year. Now, during the year, this individual received a gift of 9,000 US dollars into bank account B. And then during that same year, he transferred that entire amount over to bank account A. So economically speaking, he only had $9,000. He just received it in bank account B and transferred it over to bank account A during the year. So the question is, does he have an FBAR reporting requirement for the year? Now, before we can answer that question, we need to briefly go over what the basic FBAR requirements are. So the FBAR stands for Foreign Bank Account Report. And if you're a U.S. person and you own or have signature authority over a foreign financial asset, which includes a foreign bank account, and the aggregate value of those accounts at any point during the year exceeds 10,000 US dollars, then you have an FBAR filing requirement, or more technically known as a FinCEN Form 114 filing requirement. Now, I know that's a lot, so let's unpack that a little and see what that means practically speaking. So practically speaking, what that means is you have to check your balance on each day during the year and see what the highest value was during the year. And that's the value you use in determining the FBAR filing threshold. So you take that value for each account and you add them all together, and if it exceeds $10,000, then you have an FBAR requirement. If it's less than $10,000, you don't have an FBAR requirement. Now maybe you see where I'm heading with this now. You end up with potentially a pretty annoying result. So in our taxpayer's case, he economically only has $9,000. But if you use the rule correctly and you look at the highest value in the account at any point during the year, in bank account A, at one point during the year, he has $9,000. In bank account B, at one point during the year, he also has $9,000. So added together, you have $18,000, which is higher than the $10,000 threshold. So our taxpayer has an FBAR filing requirement, and he'll report $9,000 as the high value for each account during the year. Now, that may seem a little unfair, but the good news is this isn't a tax requirement or income that he has to pick up. This is purely an informational reporting requirement. However, the penalties for not filing can be a staggering $10,000 per year. So you want to get this right. As a U.S. expat, you're going to want to keep a close eye on your foreign bank account balances to make sure you don't cross the threshold, or you know if you have a reporting requirement, and look out for sneaky rules like this. If you're basing your determination on whether you have a filing requirement or not on logic and reasoning, you may end up missing a filing requirement because the rules are not necessarily logical or reasonable. So just be careful. If you don't know what you're doing or you need help, of course, reach out to an expert to get help. See you next time.